Kia ora and welcome to the Trends Property Insight series. I'm your host, Andrew Johnson, and today's guest helps us make sense of something that affects each and every one of us, the economy. But unlike the headlines or bank ads, this episode is about plain English explanation and practical takeaways you can use. Joining me is Nick Tuffley, the Chief Economist at ASB, and is truly one of New Zealand's most trusted voices when it comes to understanding what's really going on with interest rates, house prices, and how global events shape our local reality. From migration and inflation to OCR shifts and building trends, today's episode unpacks how it all connects directly to your renovation, your mortgage, or your next big property decision. So, Nick, Chief Economist at ASB Bank, thanks for coming in to sit down with me.
Oh, you're most welcome.
Now, you've been at ASB Bank since 2007. What got you into economics? Why did you want to do that for your job?
Well, originally I wanted to be an engineer. I think a part of me just likes understanding how things work. So I've always been interested in cars and planes and the like. So I initially studied all the things you need to be for an engineer: physics, chemistry, maths, but I found I probably wasn't that passionate for it. But I did like things like banking, finance, shares, and economics has been about just really understanding basically what drives a lot of our decisions and what are the results of the decisions we make. And at the end of the day, an economy is just a whole bunch of people all making decisions, being influenced by certain factors. So it's really just trying to understand, how are we all behaving and what does that mean for our lives, the economy, the prosperity of businesses in the country.
We make it sound quite simple, but that's why we've got you on the show today, because you're known for your plain English explanation of things like that. So, but tell me, why did you join ASB Bank? What was the calling to them? And obviously you've stayed there a very long time. So why ASB?
Well, I suppose two parts was at the time I was at another bank, and I sort of got the call when they were looking for a chief economist many moons ago.
Yes.
And I was in Wellington at the time, and I hadn't really seriously considered moving to Auckland. Wellingtonians seem to have a view, moving to Auckland, all the traffic is terrible there. Most of your experience is going from the airport to the CBD in rush hour traffic, so you've got a pretty jaundiced view. But look, the more I looked at it and sort of learned about ASB, more interested I was in taking the role, and it was a good step for me. And look, why am I still there? Look, it's actually a really good place to work. I've seen a lot of sort of great CEOs and managers come through there, and the culture and the environment's really good. And that sort of belief in what ASB sort of stands for, it just really wants to help people have better lives. So it's sort of nice purpose as well. So you feel good about working there.
Yeah, that's awesome. I mean, full disclosure, we met at a business breakfast and I was so inspired by the talk you gave. That's why I wanted to invite you on the show. But I have been an ASB Bank customer since 1984 when I had my cash and banking book. So there's a bit of bias there, but obviously, we both think ASB is pretty cool. So for you, you talk about you got into economics, or you looked at that part of it because of how it affects our daily lives. What do you get out of what you do in terms of being able to bring that information to people?
Well, we're bombarded by news and facts and data constantly, and just trying to make sense out of it. So what does it actually mean for me, for my business? I've got to fix my mortgage next week. What do I do? So a big part of our job in my team and other economists as well, is just trying to help people make sense of what is happening now and why, and what might be happening in the future as well. And it's just about helping people better understand the environment that they're in, and maybe have another dimension to their thinking when they're making a decision. So it's not all going to be about the economics, but if we're helping someone just make a better decision that will help them in the future, in the longer term, that's like a really great sort of warm fuzzy outcome.
It is. And I mean, it's part of the fundamental DNA of Trends Property. What we're trying to do is there is so many journeys you can go on and so many decisions to make, so many people trying to give you information. It's hard to know how you find your way. And so having people like you out there presenting that information is super useful. So again, why I wanted to have you on the show. So now we hear a lot about exports and things like wine and meat and so forth. So why are those always the industries? There's lots of other things we export. Why are they always the ones that people talk about?
Well, part of it comes down to what is New Zealand good at doing? We are a small country. We're a long way away from everywhere. What we have, though, is a good climate. where things can grow really fast, and a fairly decent amount of water as well, which helps things grow. So when you fundamentally look at what is New Zealand good at with some of its attributes, at least from what we get out of the land, is we can grow things, a lot of things sort of really well, or particular things really well. We're small, so we don't have the scale. We're not exactly going to become a global car manufacturer because you need to be just building so many cars, and domestically we just don't really have the scale to do that. So fundamentally, we've always been very good at growing things, whether it's food-related things, wine increasingly, forestry, the wood that's going into, say, construction activity overseas. So we've worked out what we can specialise in. By specialising in something that we're quite good at doing and very efficient at doing, we are able to then send stuff overseas, get paid for it, and in effect use that money to buy the things that we need, like oil, cars, our iPhones, things like that. So trade is about kind of specialising in what you're relatively good at doing, so you can basically afford to buy the stuff you're not so good at doing yourself, but need. So we've got to look at it. Exports are really important because strong exports mean that we're able to, in effect, as a country, afford to buy more imports, and that helps our quality of life.
Now, we're sitting down here to record this episode at the start of August in 2025, and you talk about trade. So I just wanted to have like a short segue over to the side here a little bit about the word tariff. Now, at the breakfast I was at with you giving your speech, you talked about how North America's tariffs and the president's approach to that had an effect or may not have an effect on us. And so what's your take on what's happening with the tariffs that have become big, the big word of 2025?
Well, I definitely have. Look, when we look, what is a tariff? It's basically a tax on imports. So basically anything that comes across the border, sort of in our case, what we send to the US at the moment is likely to be tariffed at a 10% rate. Basically, you import, as a US importer, you import something, the government's charging you an extra 10% on that. So that's basically potentially upping the cost of what you bring into the US to then on-sell or use in your manufacturing process. So it's potentially upping the cost. Now, a couple of things happen when your costs go up. You either pass it on to the end consumer, so that makes the end consumer good more expensive, and people potentially buy less of it when they substitute away to something else. Or if there's very little pricing power in that market and the retail price can't go up, then there might be either the importers going, look, we can't really afford to import this anymore, or they go back to the New Zealand exporter and say, look, if we're going to sell your product in the market, you need to take some of the hit on this as well. So for us, what does it mean? It means we potentially either sell less into the US market or we can't charge as much for what we sell into the US. And either way, that's a little bit of an income loss. So that's kind of like the big so what up front for us. But also because so many other countries are facing a US tariff, if they're a significant exporter to the US, well, what happens to their growth? If their exports slow quite a lot, what does that mean about how much cash they've got to buy some of the stuff that we're trying to export to that country as well? Yep. So say China's like a good example of that. So question marks around what happened to the Chinese economy. So that's the so what for us is look, there's that potential for our export incomes to be reduced a little bit compared to what they otherwise would be. And the US is now our second biggest trading partner. It just overtook Australia last year. So China's still the number one, and they're basically pretty much the number one market for most of our key exports. But US is very big, particularly with its services. Like we get lots of tourists here. Yes. We've got lots of New Zealand businesses doing smart things that are helping out, particularly in that sort of business. Think of Xero, think of what Peter Jackson does with all the movie services, Rocket Lab. They're providing a service to people in the US, and we're actually doing really well out of that. So we've seen quite a lot of growth.
And speaking of those kind of things, besides our meat and wine and the traditional Kiwi land sort of base sort of things, are there a growth in these intangible assets or these kind of advanced technology things like Rocket Lab, like Xero, which is a software system, that you're seeing as the bit of the future of what our exports might become?
Look, I think it's very well the potential where we can grow. Whilst we've done really well out of what we produce off the land, when you're looking ahead, we're looking at, say, climate change challenges. So there's either going to be that need for our farmers and our producers to be adapting to, say, the impacts of weather, or even adapting to policies that governments both here and elsewhere enact to try and combat climate change. Even our overseas customer preferences, if they start being very focused on what's the environmental impact of what we produce. So longer term, so going into things where you're less affected by that. You're not having to worry about distance, because at the end of the day, we've got to ship stuff a long way, and a lot of what we send can be quite heavy relative to its value too. And one thing that we have been sort of pretty good at doing is innovating in areas, particularly in that sort of technology area, finding a niche where we're really good at, that we can sort of fill in large overseas markets where potentially people overlook them a little bit as well. So there's definitely a role in that technology, but we've got to make sure we've got the right investment in education as well, to help make sure we've got the skills that we need to drive those sorts of industries.
Yeah, absolutely. And we're hoping with Trends Property being a very innovative digital platform that it will start to set some different trends both here in New Zealand and around the world. So I'm glad to hear that it's going to be part of the future export economy. But bringing it back home, how does that export income affect the affordability of things we have in New Zealand?
So we've always got some pluses and minuses. Like the higher that export prices are, the better returns that we make as a nation, the richer we are, the stronger our earnings are, and that helps our overall lifestyles. Flip side is, though, because we are very large exporters of some things compared to what we consume domestically, is our domestic prices do get quite heavily influenced by those export prices. Like it's not a split market, and it's the same thing even overseas as well. So at the moment, there's a lot of focus on the price of butter. We've got the finance minister turning up at Fonterra.
I'm glad you brought it up because I did want to ask you about it. So since you've gone there, butter.
Yes. So look, why is butter so high in the New Zealand supermarkets? Well, one thing we've got to bear in mind is that butter globally is able to sell for a very high price. So when Fonterra does its fortnightly auctions, or the global dairy trade auctions go, butter goes for $7,500 per tonne. So that's 12,500 New Zealand dollars a tonne. Or $12.50 per kilogram. So if you look at what that export price of butter at a wholesale level, your half a kilogram block of butter, it's a bit over $6 before you add on any GST, any packaging, any costs of moving it around and storing it, and any supermarket margin as well. So that's the spot price at the moment. So the thing is that when butter prices and meat prices are very high globally, our farmers they get a bit of good income during that period. But look, prices go through swings and roundabouts. And yes, look, butter prices might be high at the moment. We've got to bear in mind we've had a few years of quite low returns where farmers have been very, very stretched. And we've got to remember this thing called inflation happened to farmers as well. So
the dirty word, yes. Yep.
Their on-farm costs went up by about 25% in the space of a few years. So it's actually got more expensive for them to produce that block of butter as well.
And is that what sets the butter price at that high $12 price? I mean, is it just literally there aren't enough production facilities? What is making that price so high?
We've got a few things globally. One is that there's been a reasonable pickup in demand for dairy products through markets like, say, Southeast Asia, the Middle East, even China's sort of nibbling back a little bit as well. But production globally hasn't really kept up. So production in places like the EU, which is another big exporting bloc, those prices, the production there hasn't really been growing much, and same in the US. So basically, in short, production hasn't kept up with demand to eat dairy products, and that's squeezing the price up. And look, Fonterra benefits from that, or more to the point, the farmers who are getting up at 5 o'clock in the morning to milk the cows are benefiting from it. But look, when prices are low, they wear the tough times as well. And there are years where there's a number of farmers where they literally lose money.
Yeah, absolutely. So look, another key part of the economy is people. And when I was listening to you talk at the business breakfast, you talked about immigration and migration. And one of the things that struck me was your comment around the statistic of when people leave the country, it takes a little bit of time to figure out whether they're coming back or not, right? So can you just talk me through how we actually monitor the migration and immigration stats?
Right. Well, when people come into the country, you have their arrivals card, so it's filling in, where are you from, how long are you staying here for, even, things like your occupation. So we've got a pretty reasonable idea when people arrive of Are they coming here on the long term, or are they just a visitor and they're just here for a few weeks? But when people leave, we don't have these departure cards anymore. And a lot of that information was really collected for Statistics New Zealand. So the way in which they figure out whether someone's left permanently, in effect, is to wait 15 months, and if you haven't come back, then they go, right, okay, you left permanently. And in the meantime, they're trying to model it, through past migration trends and try and figure out, out of the, say, 100,000 people who left over the last month or so, out of those, how many of those probably left permanently, and how many of them well, the bulk of them are probably just people who've gone on an overseas holiday or a business trip. So it does mean that the figures get revised around a little bit, and it takes a while to know precisely who didn't come back. Yeah,
well, because they're used as such factual pieces by a lot of the media sometimes to call out certain aspects of what's going on. And so if I was away then for 16 months, what happens?
You would have probably been classed as like a permanent departure, and then you'd probably be classed as a permanent arrival coming back through. Because basically, they've pretty much got a 15-month cut-off for classing you as a permanent departure.
Right. And so we have, pluses and minuses and net gains and net losses and so forth. So at the moment, it's about a net gain of 15,000, give or take?
Yes, over the last 12 months, yes.
And so how does that compare year on year to what we'd experienced, say, post-COVID over the last sort of 5 years? How's that sitting in terms of how that affects the economy?
Well, that's sitting relatively low. I mean, that's pretty much the lowest since we actually had a net outflow of people during the time when the border was closed. We had very few people coming in, but we had a lot of people leaving, particularly people who've been here on visas and either were worried that they wouldn't get renewed, just given the time it took to pretty much do anything, or they had family that they wanted to get back to as well. So we've gone from a few extremes. Like before COVID, we were running at some pretty strong net migration figures for 3 or 4 years. It dried up during the lockdowns. We opened up the borders. We had a colossal number of people all suddenly queuing up wanting to come to New Zealand. But we also had a lot of people leaving New Zealand as well. So we managed to set all sorts of records, record number of people coming into the country, record number of people leaving the country, and a net record, figure when you took the arrivals and the departures, a record for that as well. So about 135,000 people in a 12-month period. So it has big effects. That was a period where we ended up with about 3% population growth. We probably normally average around about 1%. Possibly less these days now that we're having sort of less, the birth rate's fallen a bit.
Right.
So big influx of people. But at the moment, we've got, whilst that net flow is quite small, it's still big on both sides. We've still got virtually a record number of people on an annual basis leaving. So even though the net impact on our population growth is slow, you've still got lots of people leaving, and all the impacts that has on a housing market of people either selling or moving out of rental properties. A whole lot of new people still coming in, trying to settle and assimilate into New Zealand. So lots of movement under the surface.
And do the stats capture the type of person, the skills or the qualifications they're bringing to fill jobs? I think of things like building and tradespeople, for example, when it comes to the home industry. But how does that affect people taking skills out of the country and those people arriving who may have a different set of skills?
Well, the challenge is it's actually really hard to get a good feel for what's sort of happening with any recent trends because of that sort of probably lack of knowledge over exactly who's left in particular. Now, what we can see is that we're getting a lot of people coming in from places like China, India, Fiji, Australia, Philippines, probably like the top areas where we're seeing inbound people coming in, and we seem to be losing a lot of people to, say, Australia, for example. So there's probably like a mix of different skills coming through within that. We're tending to lose people who are in those sort of younger categories, which is quite common. The OE experience, going and doing that is that sort of rite of passage coming through. But also, fortunately, like the people who are arriving are relatively young too. So what we've got to remember is like everybody, we've got an aging population. So if you're having sort of relatively young new migrants come in and starting up families here, it's probably slowing that sort of like overall aging of the population, which is important when we're all retiring and looking for someone to pay the tax
Absolutely.
to cover our superannuation and our medical costs.
Yes, of course. And as you say, people of a younger age coming into the market, they may not be in a position to buy a home. So how does that affect rental prices or the pressure on rental? And even with people's journey into the country, they may not arrive as a citizen who may or may not can purchase a home. So really, they're all flooding into the rental environment?
Well, at the moment, if as a someone without residency, without permanent residency, you're not able to buy property. So you've got that wait until you become a permanent resident before you can buy property. So it basically forces people when they're coming in to rent for a period. I suppose when we look at it from the housing market, look, whether people are renting or buying their own home, if you've got that population increase, you still need more houses to accommodate them. So we still need to build more homes for them. But there's probably a little bit of who's going to be owning that home in the interim? And it does mean that there's probably a bit more demand for rental property when you've got quite a lot of inbound immigration coming through. But because we've got people leaving and potentially selling homes, that sort of gives, say, first home buyers who have residency or are sort of New Zealand citizens anyway, potentially a bit more choice or a bit more opportunity to buy. Particularly at the moment when interest rates are down, it's got a lot easier for first homeowners to enter the market.
And how do you see the spread across the different regions throughout the country? Are there different levels of migration, immigration? Do you see a pattern that's happening across the country?
Well, one thing that we tend to find is that when you look at where does population growth tend to be stronger, it's usually around Auckland, Hamilton, Tauranga, that sort of Golden Triangle, Canterbury, particularly Christchurch, which is where I grew up, tends to be quite a magnet within the South Island. So that's where you tend to find your population growth is stronger. I think the pattern we tend to see with inbound migration is that an awful lot of it settles, disproportionately settles in Auckland, which is understandable. It's closer, physically to most other countries. It's the main international airport coming in. Climate's warmer, even if it seems like it's sort of wetter.
Has been recently, yes.
As well. So it tends to see its population growth swell a lot more when you've got that sort of inbound flow is quite high. And I think, broadly speaking, that sort of outflow of New Zealanders is going to be a bit more spread around the country.
Now, sometimes with the economy, it can feel a little bit like an alphabet soup, if I'm being totally honest. There's all these acronyms and terms and things, right? But there's one of them that's pretty important, the OCR.
Yeah.
So for people who, we hear about it all the time, we hear these different releases, it's going to be something this, going to be something that, speculations talking about it. What actually is the OCR?
Yeah. So it's called the official cash rate. So that's we're there, that official. It's set by the Reserve Bank. What the official cash rate is it's basically guiding an overnight interest rate. So what the heck is an overnight interest rate? Well, when you think about it, banks have everyday banks are sending money in between each other, and the Reserve Bank is kind of working as a bank to the banks. So if I've suddenly got to pay, Andrew Bank, a whole lot of bazillions of dollars that I don't have, I go, well, I need to borrow a bit of money over for the next 24 hours to give Andrew some money. So I go to Reserve Bank and I can borrow some money from the Reserve Bank. And the official cash rate is basically influencing that cost of borrowing. Or if I've got a truckload of money, I can deposit it with the Reserve Bank and get paid an interest rate. So that official cash rate, all it's doing is it's basically setting an overnight interest rate that sort of works between the banks, and that's kind of having an influence on the other alternative uses of money. So you can think about pin the tail on the donkey, that whole tail is all the different interest rates you can have, but that tail is that overnight interest rate cost, and it has an influence on, longer term interest rates through doing that. So the Reserve Bank sets the official cash rate. If it sets it high, it's basically in effect dragging up the interest rate curve a little bit and having an influence on the various interest rates that are out there in the economy, even though it's just an overnight interest rate. It has that influence. So that's how the Reserve Bank kind of controls the interest rates in the economy. It's not precise control because it literally is only controlling an overnight interest rate.
Yeah.
But when people think about, okay, today the cash rate's, say 3.25% or 3% or 2.75%. If we know where it is now, and then we think about, okay, is it going to go up, down in the future? And even people's expectations of where that overnight rate will be in a year's time or 2 years' time starts to influence those longer term interest rates. So whether that Reserve Bank tweaking that cash rate up and down, giving some signals, look, we think we're going to cut the interest rates a bit further, that will have an influence on people's expectations of where that cash rate will be in the future. And that's how all those signals have a broader influence on interest rates. So in short, Reserve Bank tweaks that rate up and down, and that has an influence on those wider interest rates in the economy.
So if I do have money in the bank, are you saying that the bank is investing that with the Reserve Bank and generating income from my money that they're investing with them? Is that how that works?
Well, it could be a tiny proportion of that, but look, the banks have to hold a degree of cash ready. So Andrew's got this big term deposit, and he comes in and he goes, right, well, I want my big term deposit back. And if the bank goes, oh, sorry, Andrew, we haven't got any cash for you today, maybe come back tomorrow. We can't really do that. So you have to have a degree of cash that is there, to make sure that you can meet, someone's, large withdrawal or a big payment that's going. So we've always got a small proportion of cash there, but most of that money that banks have on deposit is being lent out. So banks are just like an intermediary. You deposit money, I lend it on to someone else. So yes, a small part might be sitting with the Reserve Bank, but it's just more, we have to keep a little bit of money there.
Yeah.
It's almost like that rainy day money. If all of a sudden a whole lot of people want to take money out, we've got to be able to redeem that. Yeah.
And you talk about them dragging the rate up to sort of signal or send a trend, because it appears that it takes a little bit of time to wash down through into the system, even into mortgage rates. Like they don't necessarily instantly change sometimes, and you see the different banks doing different things. So why are banks adjusting interest rates based on the OCR?
Well, you've got probably two things to look at is you've got your floating rates and your sort of fixed term rates. So if we just talk about the floating rates first of all, so the floating rate, the interest rate changes from the Reserve Bank, and they'll probably sit there for a little while and be quite steady. So generally what you see is like we may have a good idea that the Reserve Bank's going to change the rate, but until they've actually changed the rate, you don't necessarily know for sure. So there's two things that tend to happen is first of all, if you've got like some floating borrowing, banks are legally obligated to inform you before your interest rate changes. So people may sort of recollect whenever the Reserve Bank changes it, they'll either get a letter or an email saying, just letting you know your interest rate's going to change by X, Y, and Z, on this date. So banks have to let all those customers who have a floating borrowing rate know before they change the rate. So there's that tendency to wait until that cash rate is changed, change the underlying borrowing rate, notify people that it's happening, because it's affecting every single floating rate borrower. Right. So you tend to find that the movements in whether it's your personal loan rate, your mortgage rate, even your on-call deposit rate, those changes tend to come after the Reserve Bank's made a change, because that way banks know. Otherwise, it's like, oh, right, next week we think the Reserve Bank's going to change the rate, so we'll let everybody know now. And then, oh, whoops, they didn't. And it has an impact on the costs of funds and things. So you go, oh, hang on, we'll better change it back again and let everybody know. So that's a pretty awkward process to do.
And what kind of dialogue do you get involved with those conversations?
No, I mean that's all pretty mechanical in terms of it's a more of a people needing to be informed when there's a rate change.
But do you meet with the Reserve Bank at any point to give opinions, feedback? Is there a dialogue like that, or is it sort of church and state?
Yeah, I know there are sort of dialogues at times. They are interested in getting other people's perceptions on what's happening. They also want to, sort of give people an opportunity to ask them questions about, about their forecast and get more detail. So there's a bit of two-way dialogue over time. But obviously, they're making decisions. That's all done very much in isolation, very much within the Reserve Bank. They're totally controlling that, and they'll deliberately make sure that they are being very quiet in who they're talking to for a period. So they're always kind of like blacking themselves out for
Sure.
a period around that, out of the sensitivities that there are around that.
Now, because you've lived in the economy, you talk about floating and you talk about fixed rates, right? And people look at it and go, well, the floating rate's got a better deal for me, or the fixed has a higher rate, and it kind of can sometimes feel like professional gambling. Am I, is the bank trying to incentivize me to go one way or the other? Why do you offer two different types of lending? Why are there floating and why is there fixed?
Yeah, I suppose you think about it in terms of what does a floating rate give you? Like, it's giving you total flexibility. At any time, you can repay all that debt. You can fix it for a term. Like, it's giving you a lot of flexibility in there. But you're riding, if the Reserve Bank changes the rate, your mortgage rate's likely to change. So you get flexibility, but you get exposure to, like, whatever happens, and you've got to wear it. With a fixed rate, what that gives you is, like, for that 1 year or that 2 year term, you can pick out to 5 years generally, you're getting absolute, like, you're contracting with the bank and saying, look, I agree over the next year, I'm going to pay this rate. What does that give you? It gives you absolute certainty about what you are paying. That's it. It's agreed. If the Reserve Bank puts interest rates up or down, for better for worse, that's the rate you're paying. And the banks will then go to the wholesale markets and look at the prevailing sort of 1 year wholesale rates, and they'll, in effect, hedge that. They'll do a transaction which kind of means that they're able to lock in that cost of funds. So the banks have gone and acted in the background to ensure that they can offer you that rate. Now, the thing with that is that it's a bit different to the floating rate, where the floating rate goes up and down. Everybody's rate changes. Everybody needs to be notified. The fixed rates tend to move up and down a bit more because the only people who are being affected at any given time are the people who are choosing right now to take out a loan.
Yes. Yeah.
So there's none of this sort of notification. So what happens with fixed rates is, as wholesale rates move around, that's probably the main thing. So let's say it looks likely that the Reserve Bank's going to cut interest rates. The wholesale rates probably fall because they're going, okay, in 2 years' time, the cash rate will be a lot lower. So you tend to find that, say, the fixed rates will start to fall in the wholesale markets, and that flows through to the sort of repricing of the those sort of like fixed term mortgage rates. So fixed term mortgage rates are constantly kind of going up and down, and quite often they are anticipating the likelihood of the Reserve Bank cutting. So even though the Reserve Bank didn't cut interest rates until August last year, so we're talking about a year, basically a year ago, the fixed rate mortgages peaked in October 2023. And they started falling quite rapidly in July when it started to become increasingly apparent the Reserve Bank will cut interest rates. So the fixed rates tend to anticipate a bit more future changes. So even right now, like, the fixed rates have just basically been bouncing around for a number of months, even though the cash rates come down, because markets have been basically picking, okay, we're near the end. The cash rate's probably going to finish somewhere between 2.75% and 3%. And the fixed rates have just been sort of bouncing around. So they're already anticipating that the cash rates likely to fall in August to 3% and could fall slightly further, and that's sort of already factored in. So the rates behave in very different ways, and I think if you're looking at borrowing at the moment, you're going, right, if the cash rate falls, automatically the fixed rates will fall. It's not generally the case, because those fixed rates are anticipating where the cash rates, in effect, they're taking into account where the cash rate's likely to be over the duration of that fixed term. So if the markets are very convinced that there'll be further interest rate cuts, that's usually baked in. So that's one reason why we haven't seen the fixed mortgage rates really move down that much further, because for many months they've been picking roughly the same kind of endpoint, which is just a little bit below where we are now. So the trade, if people are waiting for the cash rate to fall with a view that will automatically mean that the fixed rates fall, it's not necessarily the case. It will be more around if there's a dramatic change in expectations of where the cash rate will be going forward. So if the Reserve Bank says, "Oh, we're not done. We've got lots more to do," those wholesale rates will fall further, and that'll flow through to the fixed term mortgage rates.
And so is that an example of sort of controlling, in a positive way, but controlling our behaviours as a nation where it may make the incentive to be able to look at purchasing a home or buying and selling because the rates are more affordable for me to actually put a good offer onto a home or to look at what I can actually borrow, and kind of how the OCR is affecting things like the inflation and where we're spending and saving our money? Is that kind of the controls that are starting to pull the levers to make the economy kind of do what we need to do to get ourselves forward as a country?
Yeah, I suppose there's sort of two bits in there. Like the choice of being able to have a floating rate or a fixed rate is sort of it's giving people a choice of how they want to manage their risk. So some people, love the idea of, okay, look, it's okay, I don't mind if there's a bit of volatility. I think interest rates are going to go down, so I'll stay on the floating rate. And some people are quite happy to sort of, take whatever happens. Other people want certainty and they'll choose a fixed rate. And it means that, say, if they're buying a property, say a rental property, they might know for the next 2 or 3 years exactly what their debt costs are going to be, and they know that they can make money, or they've got a much stronger idea of what impact it will have on their finances. So that choice is useful for people in helping them manage their personal sort of risk appetite. But more broadly, why does the Reserve Bank put interest rates up or down? Well, it's influencing our choices around spending, around borrowing, and that's flowing through to having an impact on inflation. And that's why the Reserve Bank's lifting interest rates up and down. It's having an impact on our spending and borrowing and saving choices.
And how are we tracking with that inflation at the moment in terms of, we're trying to obviously bring everything down. So what's your opinion where we're at?
Well, we've done well in that we've gone from 7% something inflation, which was some years ago, back into the Reserve Bank's target band, which is supposed to be keeping inflation between 1% and 3%. Over the sort of medium term. So if it bounces above 3%, for a brief period, that's not really an issue. But if it's sustaining itself above there, that's an issue, like it was when it was 7%.
Yeah.
Now, some good news. Inflation got back down near 2%, so near the middle of that target band, but it has started to rebound in the short term. So we're up to about sort of 2.7, 2.6, and we think we'll be hitting about 3%. Pretty much round about now. The figures won't get released for another couple of months, and then inflation will track back down. So there's perhaps some nervous twitches at the Reserve Bank because they're seeing things like food prices, so dairy, meat prices up. That's contributing to it, but food prices in general are up. Council rates may surprise you, Andrew. They're still going up.
We just got ours new here in Auckland. We just finally got ours. Yes, we know what they are now. It's great.
Yeah. So some factors like that which are pushing inflation up. But generally, because the economy's been slow, unemployment's been lifting, wage growth has been slowing. So you're seeing, cost structures for a lot of businesses, the cost growth is slowing, and that means that they don't need to push their prices up as much. So that factor is still going to be there. But in the short term, we've got this awkward spike in inflation. And so the Reserve Bank's probably being a little bit more careful, and that's why in July they paused. They just wanted to wait and see a little bit what the next inflation figures are, what Donald Trump is actually doing with tariffs, because that makes a difference to our longer term inflation outlook. So fingers crossed that they will be able to cut interest rates at least one more time. And after that, it's going to depend on so many factors, like just, is that spike in inflation going to be any bigger? What impact will the tariffs have on New Zealand? Which so far looks relatively mild, but fingers crossed.
So in terms of the journey the economy's been on, I've heard other economists talk about we're kind of coming to the end of a large turnaround process. And some of the last factors are companies having to call it now and say the costs have got to come down, or we've got to offer a new product, because we can't just sustain saying our prices have got to be high and expecting people to pay for it. And that unemployment needs to slightly spike, and then it will come back down, and that will reset this kind of large curve over the last couple of years we've been going through. Is that how you see things happening, with where we're at with the final sort of levers to be pulled?
Well, I think we're near the end of what's been a massive lurch in the economy, and you have to sort of trace it back to when COVID hit. Governments around the world didn't know what was going to happen when people either voluntarily or are compulsorily told to stay at home and potentially not work. and they threw the kitchen sink in terms of like stimulus at the economy to hold things up. And one fear was just mass job losses as well. So all that stimulus actually turned out to be perhaps far more than what was needed or overly affected. And what it did was we all of a sudden had a whole lot of money. And what do you do when money is cheap? There seems to be lots of it, and you're alive
and healthy. Yes, yeah,
healthy. Yeah, around the world we just saw people just like splurge. And so we were all trying to buy stuff globally at the same time.
With actual money or borrowed money?
Well, it was a combination of, the government providing money that fed through into salaries that otherwise wouldn't have been there. A chunk of it was borrowed money. I mean, governments were borrowing a lot of money themselves. Households were borrowing a bit more. 2-something% mortgage seemed like a pretty good deal at the time. And so that just created this massive bubble of spending. And look, we just couldn't keep up with it as a world in terms of just make the stuff, ship it around the world effectively when you had all those logistical things. So massive inflation issue. All inflation is telling you you've got too much money chasing too few things. And so that's why we see interest rates going up. Higher interest rates discourages you from borrowing more money, encourages you to save more money, and all of that encourages you to spend a little bit less. And so that's that crunch that we saw, and it was just such a big inflation bubble that it took a lot to get on top of it. So I think where we are now is it's interest rates settling back to, I guess, a sort of more new normal level, post-COVID, and that's sort of going to start taking pressure off households as they increasingly refix their mortgage rate at a lower rate. That gives more cash in there, and it means that the rates for businesses if they're borrowing to invest in their businesses they're at okay levels. They're not restrictive, they're not particularly discouraging, but we're still not in this at a level where they're having people sort of stampede to borrow money. It's sort of more sort of like in between, not too hot, not too cold level. So we're going through all these adjustments, and I think from a business point of view, is cost structures have lifted a lot. That period of very strong inflation for a number of years has just literally lifted the cost of everything up quite substantially, and we're just trying to sort of level off some of the past wage increases that we had. We're going to have to accept that at the moment, when businesses aren't rushing exactly to hire, some are still restructuring and downsizing, that there's not much pressure on wages at the moment, which is a double-edged sword. It means our incomes as everyday people aren't growing as fast, but it is helping with that sort of like cost containment for businesses, which we do need to get back onto a playing field where our wage increases are a bit more in line with our productivity growth, which is what's paying for those wage increases after a period where productivity's been, shall we be politely say, pretty poor. But that wage growth has been really strong through that period.
You talk about productivity. New Zealand gets, it's ranked really highly about this work-life balance. You hear it talked about. And does that actually reflect on that our productivity is low, and that is actually an issue, rather than having, hey, we have great work-life balance in the country? It actually does have a negative effect.
Well, I think we may think that we have great work-life balance. And I think things like flexible working is certainly helping with that. But look, the reality is we actually work very long hours. When we look at what we produce per hour, it's quite low, and we kind of make up for that by working longer hours than, say, in places like the UK and Europe. So our challenge is, look, we're sustaining a reasonable degree of lifestyle, but we're doing it by working harder. And the challenge for us is it's, I guess, that cliched working smarter. If we're producing more per hour, we are worth more. We will tend to get paid more as well, and that's probably the challenge, I think, from a New Zealand point of view. Is we've just sort of slipped behind, say, countries like Australia, in the US, where they've invested, they've grown their productivity faster than we are, and it means you've got productivity is a be all and end all in many ways of a really good quality of life. It means that just as individuals you can afford a lot, but also it means that the government can quite readily raise quite a lot of tax without having to tax us at really high rates, and have a lot of money to provide things like good health, education, superannuation. So it's got sort of more choice. So that's, when we're looking ahead, productivity is such a boring subject, but strong productivity is what makes us all collectively as a country sort of better off.
Yes. Well, you heard it here first, New Zealand Inc. Work smarter, not harder. Hey, look, now finally, you must get asked about house prices a lot because you just mentioned about rates and here in Auckland we had the revaluation and just received all of our new property valuations. And when you're looking at house hunting or you're looking to put your house on the market, you're often looking at platforms that show you the CV, the RV evaluation, and they can be quite different. Certainly when I was monitoring homes that we were looking to purchase, we tracked them over the sale journey and what they actually eventually sold for, all that kind of stuff. And there was a huge variation across the different types of suburbs and regions within New Zealand that we were looking at. So how is the house price being affected by some of these factors you just talked about within the economy? What can people be looking for? Are there key stats in the economy that are going to affect your house price over others if they're looking at what the value of their home or potential home might be?
Oh, yeah. So I suppose one thing is like that those migration figures we were talking about. Look, that can matter. What we tend to find is if you have a period of very sharp immigration, so it's a lot of people suddenly arriving in a short period of time, we don't sort of rush out and magically instantly build all those houses that those people need. So you tend to get that sort of ripple through where house prices will lift. That will stimulate a bit more construction and boost the supply of homes. But that takes a bit of time to come through. So from a housing point of view, migration, definitely something to watch for. As I say, like that at the moment, it's kind of in that sort of like neutral kind of impact at the moment. But interest rates, definitely, a big factor. It makes such a difference to the affordability of borrowing, which is what particularly first homeowners rely on because they tend to have a relatively low deposit compared to someone who's had a house for a while and built up a lot of equity. So they do matter. And I guess that's that thing where the cash rate, watching that cash rate, is it still going up or down, will have an influence on that. There are other measures like watching things like business confidence and consumer confidence surveys because basically what you think is what you do to a degree. Look, if you are feeling quite optimistic and confident as a consumer, you're more likely to go out and commit to spending money or buy a house. As a business, if you're feeling pretty confident that your outlook's pretty strong, you're more likely to hire. You're more likely to be, investing in new equipment or premises or software or whatever it is that makes your company go faster. So things like that are good barometers of just what's the temperature of people. How are people thinking? Because ultimately, look, we're not robots. We haven't been replaced by AI yet. We have things called emotions.
We do.
For better or for worse, they drive some of our key decision making as well. I'd also be pretty cheeky and say, look, we do a quarterly housing confidence survey. So we're basically asking questions like, is it a good or a bad time to buy? Do you think house prices are going to go up over the next year? Do you think mortgage rates are going to go up or down in the next year? And so it's a good sort of like temperature check of where the market is sitting now or likely we're sitting over the next few months as well.
Well, seeing as you're a human, what is your confidence like? What's the future look like from your perspective?
Well, I think we are going to see the economy recover over the next year. I think it is one we were going to have to be patient about. Now, I was starting to say that at the end of last year, and I think what it's turned out is that we've had to be perhaps a little bit more patient in some ways. We've done really well late last year, early this year, out of those export prices we were talking about. Americans love hamburgers and they don't have enough beef. Hey, that's benefiting us. So we've seen things like that propel our growth in the short term. But what we're still seeing is we're all being a little bit cautious. We're all sort of going no, after you, when it comes to pulling out our wallets and spending a bit of money. So I think we will see, particularly by the time we get around to Christmas, a lot more people will have seen their mortgage roll off a 7-6% rate onto something which is around 5 or below 5 and have a bit more money in their pockets to spend, and that will start to make a difference. But I think, look, gradual recovery coming through. I don't think we should be expecting anything that's going to be like a spectacular sort of explosion of activity and spending, but just more of a sort of gradual pickup, because probably one thing we need to bear in mind is interest rates have gone from a level which is holding us back from doing stuff to a level which is probably a little bit in between. So it's not a level where it's particularly like that sort of 2020, 2021, where it was almost like, you couldn't afford not to borrow because interest rates were so cheap. And you can sort of really see that extreme 2% mortgage rate versus 7% mortgage rate.
Oh, yeah.
What that does.
Yeah.
So if you think about that, we're kind of a bit in between at the moment when you're in the sort of around 5 or below 5. So at a sort of level where interest rates aren't exactly screaming at us to rush out and urgently buy the first property we see at the open home before the other sort of 20 people behind us pile over us and buy it over our sort of dead body.
Yes.
We're not kind of in that sort of category. It's sort of a little bit in between. So that's one of the key things that does influence the economic cycle. It is that level of interest rates, and it's kind of in that not too hot, not too cold level.
Excellent. Well, hey, I really appreciate you giving me some of your time to come on and have a chat. I can see why I hear your voice and read your words and see your face all over the place, because it's such a part of our world that we just don't get enough information about. And I think you, unlike some complicated robots that are in our world, as a human, do a pretty good job at explaining it. So I really appreciate your time.
Thanks very much, Andrew.
And thanks to you for spending some time with us. Don't forget you can find all our episodes by visiting our platform at trendsproperty.com. Here you can browse ideas, inspiration, products, people and places offering solutions for you on your property journey. Remember, you can sign up and join the Trends Property community where you can connect, collect and collaborate with others, or take advantage of our educational guides to help you take the right steps in the right direction. As always, thanks for listening. We hope to see you next time on the Trends Property Insight series, where we help you find your place, your way. Ka kite, goodbye.